Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
We're going to turn our attention to insurance in this segment. We've been getting a lot of questions from our viewers, so I'd like to talk through that topic with you.
Today, we're going to cover some strategies that may help you get the most out of your Social Security. Now, today, Logan and I are going to talk about something a little bit different.
That's right. Today, we're going to talk about the 7 levels of wealth.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm here with Cole and Kaylee from Buska Wealth Management and Buska Retirement Solutions. We're going to be answering some of your questions about planning for retirement, but if you'd like to see a question answered on a future segment, please feel free to email us at info@retirewithbuska.com. Cole, Kaylee, welcome. Thank you so much for joining me today. We're going to turn our attention to insurance in this segment. We've been getting a lot of questions from our viewers, so I'd like to talk through that topic with you. And Kaylee, we'll start with what are the essential types of insurance that everyone should have?
Yeah, so essential insurance that everybody should have at the very least would be health insurance, auto insurance, homeowners insurance, and then depending on their specific situation, life insurance or long-term care insurance could definitely be essential for them. So we always need insurance to make sure that we're, covering all of our what-if situations. And some people do get lucky and they never have to make a claim, but when we do have to make that claim, we're really happy that we have our insurance to be there and guide us and support us through those, unnecessary and unexpected scenarios.
Yeah, and the one that I would add to is, not necessarily everybody owns a home, but at the same time, you still want coverage for the property that you have or in your residence. So if you're renting a property, whether it be an apartment, a duplex, a condo, whatever it might be, renter's insurance would probably be another consideration for you because, imagine if heaven forbid, your apartment building caught on fire and, it started in a different unit but spread to your unit and all of your stuff was gone. That's not really your landlord's responsibility per se because they're covering the building, not necessarily your contents in that building. So you want to make sure that you have your own coverage that's going to protect your stuff just in case something bad happens.
That's a good point, Cole. Better to have it and not need it than need it and not have it.
Exactly.
Right?
Mm-hmm. Exactly.
So Cole, how can our viewers determine whether or not they actually have adequate insurance coverage?
That's a good question. We always preach to make sure that you're looking at those types of things on an annual basis is probably not a bad idea, especially with like auto and homeowners and renters insurance and those types of things. Maybe not life insurance per se. It does make sense to periodically take a look at that, but I don't think that necessarily needs to be annually. But in terms of your other needs, your needs may shift, Obviously you might have additional things that you've purchased over the course of time that might require additional coverage, or for you to schedule items in your policy, whether it be jewelry or whatever. When you think about those types of things, we might not necessarily immediately, oh yeah, I should put that on my insurance, or I need to adjust my insurance because of those types of things. But things change, no different than our financial plans. We need to make sure that we're looking at our insurance policies periodically. Also, looking at, maybe working with an independent insurance agent could be really beneficial. They can shop rates around with multiple different carriers, help you to understand if there's savings by going one direction versus another, and also doing a needs analysis to make sure that you have enough coverage to fit what you specifically need for that point in time. I think that would probably be a good place to begin, is maybe just scheduling a review with your existing insurance agent, or maybe, finding a new insurance agent if you don't currently have one, or if maybe you're just not fully satisfied with your current relationship. There's lots of other professionals out there that are going to be willing to help you do those analysis and make sure that you have adequate coverage.
Very good. But there are some things that we need to watch out for, not just ensuring we have insurance coverage that's adequate. Kaylee, can you talk about what some of the common insurance scams are and how to watch out for them?
Absolutely. It's unfortunate how many scams are out there these days, and scammers are getting smarter and smarter. But some of the most common ones would be phishing scams. So either through text message, email, phone calls, that's where they're asking for personal information or maybe some sort of payment. Definitely be aware of those questions. That should be a red flag. Mm-hmm. Also, something else that I thought was pretty interesting was fake insurance policies. So people, will say that their rates are really good or the premiums are really low. So always be wary of that. If it seems too good to be true, chances are it probably is. So just make sure that you're always protecting yourself by doing your research and looking into these companies and these agents before you're actually engaging with them. And then also make sure that, you're doing your due diligence to be skeptical and always wary. You can never be too cautious.
Yeah. Well, and that's part of the reason why it's maybe not a bad idea to do some due diligence with the Office of the Commissioner of Insurance. If you're being offered some sort of insurance and you're just not 100% certain, maybe reach out to the OCIC if they're aware of any complaints about this particular company, or if there's any concerns with the company's licensure or anything along those lines. As we always say, you have to be your own best advocate. You have to be on the lookout for these different scams. And like Kaylee said, they are getting smarter, they're getting more creative, they're getting more aggressive with their tactics of trying to separate us from our money. So if you have a concern, follow that up, go and ask questions of the insurance commissioner, talk to other professionals in your life, financial professional, tax professional, make sure that whatever this particular, whether it be a policy or, a letter from the IRS or a call from the IRS or whatever, there's so many of these out there nowadays that you have to do your best effort to protect yourself.
And if it does happen to you, make sure that you're reporting it.
Absolutely.
Either to local law enforcement or the OCI.
Yeah, don't be embarrassed about it. Because you reporting that might help prevent someone else from falling victim to that. So I get it's easy to be frustrated and, hold ourselves accountable for those types of things and maybe be embarrassed. I can understand that completely, but at the same time, if we're not reporting it, we could be leaving other people open to be the next victim, basically.
Yeah, we don't want that. So there's a lot that can change. We want to make sure we have adequate insurance coverage. We want to watch out for scams. Cole, can you wrap us up here? How often should we be looking at our insurance coverage?
Well, I think I alluded to that a little bit earlier, but I think at the very least, when it comes to your traditional insurances, your auto, your homeowners, your renters, all of those types of things, that you should be probably looking at least on an annual basis. Typically your policy is going to renew every 6 to 12 months when it comes to like your auto. Your homeowners is going to renew typically once a year. And so it's a good idea that as you're approaching those renewal dates that you put your feelers out there to see if there's coverage, the same level of coverage for, less of a cost or maybe more coverage for the same cost, whatever it might be. It's just a really good idea to make sure that you're getting the best bang for your buck and that your dollar's going as far as it possibly could. Because, if you can get the exact same policy from another reputable company and save yourself $500 or $1,000 a year, we can think of a lot better ways to spend that money than wasting it on an insurance policy that you could have gotten elsewhere cheaper. So I think it's really valuable to just take a step back every once in a while. And granted, it's not fun to have to do, but hey, if you find an extra $500 or $1,000 a year, That's fun.
Yeah, that's fun.
We could find some fun things to do with that, right? Put that towards vacation, whatever it might be. Anything other than an insurance policy is probably going to be more enjoyable.
Yeah, absolutely, but necessary.
Yeah, absolutely.
All right, well, thank you both for answering all of our questions about insurance today. And thank you all of us for joining us. We'll be back with more right after this.
The Tax Cuts and Jobs Act of 2017 reduced income taxes for many American households, but many of those provisions will expire on December 31, 2025 if Congress doesn't act. That could mean that you'll pay higher taxes, but you can take more control of your retirement by prepaying some of those taxes now at the current rate. Call us at 715-355-4445 or visit retirewithbuska.com for more information. Are you looking for someone to help make retirement planning a little easier? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our three companies, there's a lot we can do to make your retirement planning process less stressful. By creating a holistic retirement plan that incorporates investment management, income planning, tax planning, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions and Buska Wealth Management. Today, we're going to cover some strategies that may help you get the most out of your Social Security. One strong potential strategy for increasing retirement income is waiting until you reach the age of 70 to file for Social Security, of course. Now, a U.S. News and World Report article entitled How to Delay Claiming Social Security Until Age 70 has some valuable information, including that you may want to consider spending down other accounts before you file for Social Security. For example, you may be able to utilize a 401k or IRA while waiting for Social Security. Savings and investment accounts are often accessible for several years before filing for Social Security at age 70. If you do take advantage of another account, you should only take what you need because overspending may weaken the power of waiting for Social Security. Now, make sure to work with a financial services professional to review your cash reserves and accessible savings accounts. And remember, prior to retirement, you should have enough cash to cover at least 1 year of spending. This cash may allow you to cover some of your essential expenses without withdrawing money from other investments before filing for that Social Security benefit. Now, during your conversation with your financial services professional, be sure to discuss CD and bond interest, money from dividend-paying stocks, and possibly selling appreciated assets that you've kept for more than a year if any of these apply to your financial strategy. Annuities may be another opportunity for supplemental income. Annuities are contracts with insurance companies that may provide guaranteed lifetime income in exchange for a lump sum payment. Now, while there are many types of annuities, you'll need cash at the outset for a contract. You may be able to structure annuity payments for the years between your retirement date and your 70th birthday. If you want to retire at 55, you may be able to utilize a 15-year fixed period certain annuity. But annuities aren't necessarily a good option for everyone. And because there are many different types of annuities, determining which one is right for you can sometimes be hard. Therefore, if you're considering an annuity, make sure you consult with a financial professional. Next, you may want to consider staying on the job. If you're in good health and you enjoy your career, why stop? Working beyond the age of 65 may help you secure your ideal retirement lifestyle. And remember that your peak earning years are often shortly before you retire. So working an extra year or two may not only help you earn delayed retirement credits for Social Security, but it may help you increase what you have in your retirement accounts as well. Another option is to move to a smaller home. Downsizing your home is still another way you may be able to hold off until you're 70 to begin receiving your Social Security benefits. Are you an empty nester with a 4 or 5 bedroom home? Selling and moving into something smaller but that still meets your needs may give you a large amount of cash while also saving you money on taxes, upkeep, and utilities. Currently, the tax liability exclusion for a primary residence is $500,000 for married couples and $250,000 for an individual. And finally, remember to factor in your spouse's payment. As you contemplate your making it to age 70 Social Security strategy, you may also want to analyze your spouse's likely monthly payment. If you're both eligible for Social Security payments, first consider whose benefit will be larger. From there, one possible strategy may be to begin taking the smaller benefit immediately while delaying the larger payment. Furthermore, the survivor benefit allows the spouse who lives the longest to receive the bigger of the two monthly payments. Now, before I sign off, I want to discuss a few ways that you can increase your Social Security payments long before you reach age 70. A U.S. News & World Report article entitled 10 Ways to Increase Your Social Security Payments offers us a few additional tips. First, work at least 35 years. The Social Security Administration calculates your benefits using the 35 years during which you earned the most money. If you only worked 30 years, then the 5 years you didn't work would show up as zeros in the calculation and therefore lower your benefit. On the other hand, when you work more than 35 years, a higher earning year can cancel out a lower earning one and generate a higher payout. Next, try to get raises when you can. When you earn more, whether through a pay raise or additional income from a side job, you may be able to increase the amount you receive in Social Security when you retire. Another great tip the article mentions is to check your records. Create a My Social Security account and compare your earnings history with your W-2 or pay stub to make sure the information is accurate. If you spot a clerical error in your earnings history, contact a professional who can help you get that sorted out. And with that, I am out of time. If you have any questions about your Social Security benefits and how to get the most out of them, contact our office today at retirewithbuska.com or call us at 715-355-4445. We'll be right back with more of Financially Speaking after this. Have you heard the term fiduciary before? According to Investopedia.com, being a fiduciary means being legally bound to put your client's best interest ahead of your own. Did you know that investment advisors have a fiduciary duty to clients, but broker-dealers just have to meet the less stringent suitability standard, which doesn't require putting their client's best interest ahead of their own? At Buska Wealth Management, all of our advisors are fiduciaries to provide our clients more peace of mind. Call us today or go online to schedule your complimentary review. You've worked hard to save money for retirement, but wouldn't you rather thrive and not just survive your golden years? My newly released book, Golden Rules of Finance for the Golden Years, offers key tips for managing your retirement money and ensuring you have a more complete plan to make your retirement dream a reality. Call 715-355-4445 or visit buskabook.com to request your complimentary copy today.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions and Buska Wealth Management. And joining me today is Logan Waller. Now today, Logan and I are going to talk about something a little bit different.
That's right. Today we're going to talk about the 7 levels of wealth.
And I'm excited about it, Logan. I think this is going to be a fun conversation.
I think so too, Cole.
So we're going to talk about an article that was recently published in MoneyWise entitled Financial Freedom. Author Grant Sabatier says that there are 7 levels of wealth.
That is one long title.
It sure is. But let's dive into the article.
All right. First of all, let's tell the audience who Grant Sabatier is. Maybe they've heard of him and maybe they haven't.
Well, he is a writer, podcaster, and entrepreneur. He's written bestsellers such as Financial Freedom, A Proven Path to All the Money You'll Ever Need, and Inner Entrepreneur, A Proven Path to Profit and Peace. Grant is also the CEO of MMG Media Group.
Didn't he also have a blog called Millennial Money?
That is right, actually.
Okay, so what does Grant say about the 7 levels of wealth, Cole?
Well, the idea is that the levels are part of a ladder that helps you reach financial freedom.
I like the sound of that. What's the first level?
Well, the first level is clarity. Grant argues that understanding your financial situation is the first step. That means having a handle on your income, savings, and debt.
Well, that makes sense to me. Understanding how much you need to cover all your expenses and having a clear idea of your financial position can be empowering, especially during times of economic uncertainty.
That's right, Logan. Plus, once you know where you stand financially, you can make a plan.
What does that plan look like?
Well, the article recommends using a budgeting app to track every dollar that comes in and every dollar that goes out. That will help you better keep track of your spending and get a handle on your debt to income ratio.
That's great. And I hope our viewers who have already done this are pleased to know that they are past step 1 on the road to financial freedom.
That's exactly right.
What's the second level of wealth?
Well, level 2 is self-sufficiency. At this level, you're not relying on anyone for financial support. You may be living paycheck to paycheck, but you're paying your mortgage, utilities, and other expenses without adding to your debt.
How common is it for people to live paycheck to paycheck?
Well, the article refers to a study that says half of Americans live paycheck to paycheck.
So, in other words, if you're at level 2, you definitely want to keep climbing.
Absolutely.
So, how do you climb up from this level?
Well, you want to save and build an emergency fund. It should have at minimum 3 to 6 months worth of living expenses in it, so you'll be able to cover expenses in case something does go wrong.
What about lifestyle inflation? We sometimes see people who start spending more as they make more.
The article recommends avoiding lifestyle inflation, and I agree. Don't let increased spending erase your raise.
Amen to that. Now, let's move on to the third level of wealth.
Well, the third level of wealth is breathing room. It means you're not living paycheck to paycheck anymore. You're not worried about covering your bills, and you have some discretionary spending. At this level, you have all your ducks in a row, and you can take the occasional trip or have a dinner out now and then as well.
That sounds like a decent place to be, but there's still room to grow. How do you get to the next level from here?
Well, the article recommends paying off any high interest debt and saving more. Emphasize putting your money where it's going to help you the most. For instance, once you get your debt paid off, you can take the money that you were paying on the debt and increase your savings rate by that amount. That way, you may be able to build wealth while enjoying life along the way.
Well, that's great.
Absolutely. And once you've done that, you can reach level 4, which is stability. At this level, you have a solid foundation and don't worry about unforeseen expenses.
Does that mean an unexpected expense won't force you to go into debt?
Well, that's correct. From here, you can make regular contributions to savings and investments. Also, you may want to have insurance policies such as life insurance, disability insurance, and of course, health insurance to protect those assets.
Great. What's level 5?
Well, level 5 is flexibility. Once you've reached this level, you can take a little more risk.
What kind of risks can we take?
Well, for example, you can change careers or become an entrepreneur. If there's a passion that you'd like to pursue, you can do that at this level because you have enough money to bail yourself out if something goes awry.
We're 2 levels away from financial freedom. How do you move up from level 5?
Well, you keep building diverse income streams, invest strategically in stocks and real estate, or maybe start a side business.
On to level 6.
Level 6 is financial independence. You reach this level when your investments are making money. People at this level may be in the very enviable position of not having to work. At this level, you may want to max out your contributions to your 401ks and IRAs. You may also want to invest in rental properties or stocks to generate some passive income.
In my opinion, you should make sure your portfolio is diversified. That way you can maintain your financial independence when the market fluctuates.
Absolutely, I completely agree.
All right, we've reached the last level. Drum roll, please.
Don't look at me, I'm not doing the drum roll.
Fine, so what is level 7?
Well, level 7 is abundant wealth. You have more money than you need, you can live your dream life, and you can potentially get into philanthropy.
Is there anything left for folks to do when they reach this level?
Well, yes. Now that you have this level of wealth, you may want to take steps to preserve it.
Oh, how can people do that?
Well, wills and trusts are essential for making sure that wealth passes efficiently to the next generation. Diversified investments can also help you preserve your wealth also.
Well, this was a great list, Cole. I wonder if the folks out there watching are thinking about what level of wealth they are currently on and what they need to do to get to that next level.
Well, I hope they are thinking about it. This list offers some great perspectives, and I think many people who see this will feel better about their situation. I mean, many people might be in better positions than they might think. They might think that they're not on the path to wealth, but are really already on level 4.
And even if you're at level 1, you're on the first step towards building wealth. Notice that there's no level 0. Nothing on this list is level. Sorry, you're stuck here forever.
Right.
There's always a way forward.
Absolutely. I love that term.
I also think it's interesting that this article doesn't say how much money you have to reach any of these levels.
Well, it's all relative, isn't it? I mean, a person who is very frugal could reach levels 4 and above on a modest salary if they stay disciplined and follow the steps. Meanwhile, someone with a high salary could be on level 1 because they don't track their spending, have high levels of debt, and maybe live above their means.
It's so interesting when you think about it that way.
Absolutely. I think it should give people some hope. You can do this. Even if you don't get to level 7, you can get one level higher. You can get to a place where things are better.
I think a financial services professional could help with that. If you want to know how to get to the next level and figure out what is the best way for you to do that, a professional who can look at things objectively can help you find the right strategy.
Absolutely. That's a good point, Logan. The article lays out some general ways of getting ahead, but to really get into the weeds and find a strategy that will work specifically for you, you may want to get some outside help.
And on that note, we're out of time. Viewers, whether you're on level 1, level 7, or any level in between, we are here for you. Contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more Financially Speaking after this.
Are you looking for someone to help make retirement planning a little easier? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our 3 companies, there's a lot we can do to make your retirement planning process less stressful. By creating a holistic retirement plan that incorporates investment management, income planning, tax planning, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. Remember, this is the same way that we communicate to our clients when we meet with them in person. And remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your current retirement plan. So call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on some previous episodes of our TV and radio show, or to schedule your complimentary, no-obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.